Well, hey there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you on Thursday, May 1st from a beautifully warm and sunny Redmond, Washington. Hope the weather is good and that you are doing well wherever you're at and whenever you're tuning into today's market recap. April is now wrapped. We're officially about a third of the way through Q2. We're in the midst of earnings season. We'll see what's happening in the after hours with names like Apple and Amazon. Initial reaction kind of to the downside with those stocks. So we'll see what sort of follow through we get. We certainly got a bounce higher today from Microsoft and Meta, but not necessarily closing in a position of strength, a bit of distribution through the course of the day today. So far, if you're looking for some sort of closure after today's session, I don't know if you're going to get it. And this goes into tomorrow after all of the earnings. I think we're still trying to get our head around. Got a bunch of energy companies reporting earnings, including the two big ones, Exxon and Chevron tomorrow. Also the PCE number, which is the Fed's preferred inflation gauge. So plenty of things to digest and to think about. Let's get right to the charts and see how things played out today. Looking at the market recap here, looking at the market overview page on stock charts, we can see the S&P up 0.6%. That's a close just above 5,600. Earlier in the day, we got up as high as 5,650 plus, but through the course of the afternoon, particularly in the last 20 minutes of trading, we rotated to the downside and ended up finishing pretty much at the lows of the day after today's upside gap to kick things off. Now, the NASDAQ 100 rallied to the upside around 1.5%, and that's led by some of those big tech earnings that we talked about earlier. We'll look at those charts, of course, when we get to the chart review. Dow up slightly, about 0.2%. Mid caps, small caps, all in the green. So end of the day, this is a positive day. The difference between today and yesterday really goes with the contours of what happened through the course of the trading day, right? Yesterday, we can see on the chart of the S&P, opened weaker, closed stronger. Today, kind of the opposite, opened stronger, closed weaker, right? It's sort of a different contour, not necessarily giving a warm and fuzzy feeling into the close. But again, we keep closing higher. That's not bearish. Now, the VIX, essentially right where we were yesterday, down a dime from yesterday's session. So we're still right around 25 on the VIX. That is technically a high volatility environment. I've seen some people that look, say, a VIX between like 20 and 30, sort of a neutral VIX, or a, not high volatility, not low volatility, kind of neutral volatility. And I get that argument, but it's not low. And that is pretty much the reality. Looking at the fixed income markets, bonds selling off today. The TLT was down about 0.5%, so not a huge down day, but enough to move rates a little bit higher. The 10-year yield getting really close to 4.25. The 5-year point just above 3.8%. The short end of the curve, of course, remaining steady. At the next Fed meeting, the market's pricing in essentially no real significant chance of a lowering in rates at this next meeting, but at the next two meetings, basically pricing in a 25 basis point cut at both of those. So if that would happen, then we would get rates generally staying where they are and the Fed sort of lowering the short end of the curve. That's how the yield curve gets more normal shaped. Before you get too excited about that, remember when the yield curve has been inverted, which it was going into 2025, and then becomes normal shaped, which it's kind of in the process of doing, usually means returns for stocks are not particularly great for the next 6 months before they eventually recover, right? Because it's a sign of optimism, but the market's not really pricing in that optimism necessarily yet. Although the short-term rally certainly feels pretty encouraging. The dollar drifting a bit higher here. You can see the UUP was up about 0.6%. On the commodity space, precious metals down again. Gold had a pretty rough week here, probably the worst week in 2025. I would guess. I don't have the numbers in front of me to confirm that that's the case. That's what it felt like. GLD down another 2.1%. We're around 297.50. Silver prices down slightly as well. The rest of the commodity space actually in the green. Crude oil had a decent update, and that's after this week generally has been pretty rough for crude. Energy sector making new relative lows this week. The worst performer out of the 11 S&P sectors in the month of April. So overall, energy not quite giving great signs yet, but you're seeing a nice rotation higher today. We'll take it. Natural gas prices probably the best performer here, up about 3.5%. Looking at the crypto space, boy, a lot to continue to like about cryptos. Bitcoin up another 2.6%. Ether prices up about 2.9%. They trended slightly lower through the course of the equity session, but really have appreciated in the last 24 hours. Bitcoin got up to around 97,500. We're currently around 96,600 as we go live with the broadcast here. But again, that breakout above 90 to 91,000 continuing to follow through to the upside. And I do own positions in Bitcoin and Ethereum and the GLD and a bunch of index funds, as I'm sure you could probably guess. Full disclosures behind us. Let's continue on to the sector performance. Not a bad day sector-wise, right? Besides healthcare having a pretty rough day to the downside, the rest of the sector is not too bad. You had 7 up, 4 down. Best performer technology. Now, Microsoft had pretty decent earnings. Nice gap higher today. That's certainly helping propel that sector to the top of the leaderboard. Industrials, the XLI, number 2, up 0.8%. Consumer discretionary, the XLY, up 0.6%. Industrials are interesting. I mentioned yesterday on the show the top 10 charts to watch for May. That episode with Grayson Rose and I went live on the Stock Charts TV channel earlier today. So you should definitely check that out if you're looking for some ideas, some thought-provoking discussion about stock picking in this sort of environment. But at least 2 names in the industrial sector, if I remember right. One in particular that I can come up with was a defense stock or an aerospace name. I forget what the second one was, but I feel like 2 out of the 10 were in industrials. So worth a watch there. On the downside, healthcare down 2.7%. Clearly outpacing everything else to the downside. Consumer staples, one of the more defensive sectors, continuing to underperform. Consumer discretionary this week, that's down another 0.9%. Materials down 0.4%. Looking over here at the breadth, it moved around quite a bit through the course of the day today, right? Because we had the sell-off going into the close, but end of the day, the S&P 500, a lot more stocks going down than up. You compare that to the New York Composite Index, and the NASDAQ sort of had the opposite. So the top line is the New York Composite Index, 54% positive, 43% down. The S&P 500, 43% up, 57% down. So the breadth in small caps and mid caps better, the returns in the S&P 500 better. And so what that means is basically those big names with the mega cap weighting, the huge market cap, enough to drive the market higher, despite the fact that the breadth wasn't particularly impressive today. What else can I tell you? Let's look at the Magnificent Seven and Friends. This is how we have quite a bit of earnings this week. Microsoft and Meta both up today after reporting earnings yesterday after the close. We saw the initial numbers in the after-hour session yesterday. Pretty impressive on both counts. Both of those opened a bit higher. Both of them closed a bit lower. We'll look at those charts individually so you can see what I mean. But Microsoft still finished the day up 7.6%. Meta finished up 4.25%. Strong up day. Amazon going into today's earnings report after the close today up 3.1%. Apple down here. Not much of a gain going into today's earnings, only up about 0.4%. Both of those names, by the way, look like they're down as investors are digesting earnings. We'll take a look at those charts here in a moment. Tesla continuing to fail in its attempt to get above resistance, down 0.6%. Bit of a gravestone doji kind of candle is what it looked like when I took a look about an hour ago. I'm not sure if that actually played out around the close or if I saw that before the close, but that's how things were looking going into the end of the day. All right, let's get to the heat map analysis here, looking at the market carpet tool on stock charts. As a reminder, I appreciate you guys tuning in live on Facebook, LinkedIn, YouTube, and X. Looks like we're coming through well on all of those platforms. I see a number of questions with all of the on those different platforms, and I appreciate it so much. Keep the questions coming as we go through the session today. Drop a question in as it pops in your head. I'll try to grab a question or two before we wrap the episode. Anything we don't get to, we'll put it in the mailbag. We're planning an all mailbag episode tomorrow on Friday, May 2nd. We love to feature one of your questions in our episode. Those all mailbag episodes have been a lot of fun. Some really thoughtful questions you guys are asking. Little ones I can get to during the broadcast. Bigger ones, it's helpful to take some time and kind of thoughtfully prepare some reaction to what you're asking about. So I appreciate you putting questions in. If you're watching this on delay, just put it in the comments section on our YouTube channel. We'll gather them all the same. All right, looking at the market carpet here, I mean, what stands out to you? For me, it's healthcare right in the middle with a lot of red. Eli Lilly got absolutely dinged today, down almost 12%. A bunch of other names in that space, in the pharmaceutical space, in services, kind of in a little of everything, kind of getting pushed to the downside, right? You have UNH down 2.6%, Merck, another pharmaceutical name, down 2.3, Amgen in the biotech space, Gilead having a really rough day as well. So the average stock not doing particularly well. And healthcare, kind of struggling. It wasn't the worst sector in April. That was energy, but the second to last sector was healthcare. So certainly not great. There are random names in there having decent charts. Are starting to break out. CVS, for example, threatening a new all-time high today. So they are there, but they're the outliers. The average stock in healthcare is sort of struggling here, particularly on a relative basis, as a lot of growth names are doing a lot better. Here in the upper right, you can see consumer staples generally in the red. One of the big, I think, tells in the market here over the last couple months coming out of that February peak was the rotation from offense to defense. And we can look at that a number of different ways, right? We can look at the ratio of the XLY to the XLP. That's my favorite way to do it. And particularly looking at the equal weighted version of those two sectors, things you want versus things you need. That's been clearly favoring things you need or consumer staples until the last week, right? And that's when you've seen a bit of a rebound and you're seeing offense outperform defense. You're seeing the XLY outperform the XLP. And also, if you look at the relative strength of the average defensive sector like utilities and real estate, they're not underperforming. They're just not dominating on a relative basis that the way that they were, sort of going into the April low. It's sort of quieted down quite a bit. So certainly feels like we're in a rotational, I mean, at least a counter trend move, with a big mean reversion on the trade that worked so well from mid-February to early April, which is get out of offense, certainly growthy offense, get into defense, particularly, true defensive sectors like consumer staples. Now we're seeing that mean reversion. We're seeing that that alligator mouth start to close as growth, which is struggling, turns higher, and defense and value sectors, which have done well, start to rotate lower. Gold, which had done so well, starting to rotate lower. The problem I have is a lot of those growthy sectors don't look great yet. They just don't look bad anymore. And charts like gold don't look bad yet. They just don't look, they're not just going up at the moment. So it certainly still feels like a bit of a counter trend reaction. Although I know these are big swings and it's a lot of volatility to digest. But based on my work, that's still how I'm inclined to label what I'm seeing and hearing in the markets right now. Other things that stand out to me besides the weakness in some defensive areas, the weakness in healthcare, the bright green in some of the biggest names. And if you're wondering why the benchmarks were higher today, there's your answer. And I mean, the way to think about this, right, is kind of cover up either mentally or with your hand on your monitor, cover up like the left, eighth of the screen. So you cover up Microsoft, NVIDIA, Broadcom, Oracle, and Amazon. Cover up Meta and Alphabet in the bottom. The rest of this heat map does not look particularly good today. It actually looks quite negative, right? And this is why the breadth in the S&P was not great, at least for today, right? Because the average stock was sort of down. It's just the names that were up represent big market cap, big weights in the benchmark, and as a result, benchmarks are going higher. I don't see a scenario where the S&P or the NASDAQ see meaningfully higher advances beyond what we've seen without these mega cap growth names leading again, right? I mean, that's what it would take. So for this week, it's looking pretty interesting. We'll see what happens as we digest today's earnings and we digest the PCE number tomorrow. It could be a very different look to this market by Friday at the close. One of my mentors, Jeff Weiss, used to tell me everything between Friday close and Friday close is noise. Wait for the Friday close, Keller. Although I don't know if he called me Keller at that point, but that's what I heard in my brain. Listen, Larry, I see your super sticker on YouTube, and I can't thank you enough. That's a really nice gesture. I appreciate you watching and appreciate you weighing in. Also, my friends at Earnings Beach, shout out to Tom Boley and the team there tuning in from the Mid-Atlantic region. Good to see you on here. Thanks for tuning in. All right, let's look at the charts here in the chart review portion from top to bottom. We'll start with some of the macro themes. We'll go through some of the different charts, and then we'll take a question or two before we wrap today's live stream. Here's a daily chart of the S&P 500. Here's the good news. We gapped above the 50-day moving average. We have not been above the 50-day moving average since the end of February, right? All the way back here on the chart is the last time we actually were above the 50-day moving average. That's been quite a long time. Now, the 50-day moving average is still sloping downwards. The 200-day moving average is essentially flat, and we are still below the 200-day moving average. For me, that's why 5750 remains a really important level. I think this market above S&P 5750, hard to deny that the strength off of the April lows is manifesting into a much broader period of accumulation. I'm still inclined to label this as a counter trend rally within sort of a bearish framework until and unless we can get above that level. And the good news about that, and this is why, if you worry, well, if we buy right there, are we the last buyer? I don't think so, because there are a lot of people like me sort of looking at this and still seeing, you know what, it's just not enough yet. But above the 200-day certainly looks like you'd be silly to not be allocating capital to risk assets, including the S&P and the NASDAQ. I'm not the only one with that general thesis in mind, I would argue. So it's sort of an if-then statement. If we get above 5750, if we clear those late March highs, I could reasonably expect us to go much further. I think we retest the February peak at that point. We can argue all day about why that shouldn't be the case and why a lot of the macro conditions are still not great. The market does not care what you and I think, though. And if it's going higher, I want to own things that are going up. The momentum is another thing that I would like to see improve, right? The RSI is still around 56, getting better. But, RSI sort of below 60 is kind of what it looks like in a counter trend rally scenario. Above there, you have to acknowledge that things are getting better. Another chart that just makes me not feel like this is an obvious that the market's going a lot higher yet is the fact that the breadth is still not particularly strong. And it depends on where you look, right? Things like the McClellan oscillator, bullish. That's a short-term measure of breadth. Things like the NASDAQ 100 bullish percent index, which I'll show you in a little bit. Pretty good, quite bullish signal, arguably overextended, suggesting we're maybe toward the later stages of a counter trend rally, as we'll get to in a few moments. But this chart, which is looking at the percent of stocks above their 200-day moving average, still only around 38%, which means over half, most of the S&P have yet to get above their 200-day moving average. If the S&P gets above its 200-day, if this indicator gets above 50%, I think you'd be pretty crazy to not be pretty constructive about market conditions at that point, because you've run out of things that don't look bullish, right? I mean, that's just validating the uptrend. But things like this are not quite doing it yet, which makes me, again, assume that this is a very volatile but still generally downward trending on that longer term time frame. Another chart to think about, I mentioned the NASDAQ 100 bullish percent index, and this is the chart that I was talking about. This is looking at the 100 stocks in the NASDAQ 100 and asking a simple question of every one of those charts. Is the point and figure chart most recently giving a buy signal or a sell signal? And a whole separate webcast we can do someday is how bullish percent indexes are created based on point and figure methodology, because you got to go through a lot of that detail. But I will tell you that point and figure buy signals are not easy to come by. It's not when things are going down you don't get a buy signal. It's when the chart actually turns up enough to create what's called a double top breakout, where a column of X's goes higher than the previous column. And it really signals that the trend is rotating. We've seen that on most members of the NASDAQ 100 since early April, right? At the April low, 6 out of the 100 stocks were in a bullish framework. As of today's close, that's up to 75%. So literally 70% of the NASDAQ 100 members have gotten a buy signal from their point and figure chart in the month of April. It's not bearish. I mean, that's pretty encouraging. Here's the problem, right? Look to the left on this chart and look at what happens every time the bullish percent index gets above 70%. Oftentimes that's not bad, and that can be the beginning of a bigger upswing. But here's the problem. Look for when the indicator comes out of that overbought region, and that's when you can find some of these tactical peaks. That's when, it sort of suggests that we're leaning a little too far out over our skis and we're getting a bit of a pullback. Whether or not it's an end of the world pullback remains to be seen, but it certainly suggests that whatever was happening that caused that extreme bullish condition is no longer in play. And so pullbacks usually happen and are confirmed when the index does this, when the indicator goes above 70% and then breaks below. And that's why this one is an important one to keep an eye on. And again, you think about how the market has rallied in April, driven by the strength in these growth stocks. This is the market cap in big tech, communications, consumer names that has propelled the benchmark so high in the month of April. In the month of May, the danger is this goes back down and those big leading names pull back and give back some of those gains. Watch how quickly the chart of the S&P and the Nasdaq, which looks so constructive on that tactical time frame, can look very, very different in a very rapid time frame. So let's keep an eye on that breadth indicator together as we go on. Looking at some survey data, a lot of the sentiment data is updated Wednesday into Thursday. So today's a good day of the week to sort of check in on what the sentiment data is telling us. I would say the AAII survey, which is a weekly survey of individual investors, has tilted a little more negative this week compared to last week, which is a bit of a head scratcher, given the fact that the S&P is higher than it was a week ago. But you can see what's happened in the survey data here. We have down around 21%. That's down 2% from where we were last week. That's not a big plunge or anything. It's just slightly drifting lower. You can see there's an increase in bears. There's a decrease in bulls. So the spread between the two is around 38%. That's a pretty wide spread with bears far outnumbering bulls. And before you get too excited about, all right, that's a really low level, is that bullish? It's pretty much exactly where we were here at the end of February, and that's before we continue to sell off quite a bit. So what I've learned about this survey is looking at the general range of the AAII survey, looking for when, extreme bearish conditions don't necessarily tell us that we're, capitulating. It just tells you there's not a lot of people that are particularly constructive about the markets. Sustained bear markets will feature these levels for an extended period of time. Look for some optimism to be reinjected into that survey. You're seeing a hated rally here, right? You're seeing the market rally as less and less bulls are showing up every week in that survey. I don't know if that's a great confirmation of uptrend or optimism at this point. With that in mind, look at this one. This is the Name Exposure Index. This is a weekly survey of money managers basically asking for their weighting in the equity markets, right? And you can answer up to 200% long, I believe down to 100% short. And so every week you provide your allocation to the equity markets. It's currently around 60%. That's still underway, right? The average is more in the 70 to 80% range going back over time, but that's a lot higher than 41%, which is where we were at last week. And that's even higher than 35%, which is where we were 2 weeks ago. So you are seeing money managers in this survey, after steadily declining their exposure to equities from the February peak to early April, now starting to see respondents, at least in terms of what they're reporting, reallocating a bit into equities. So definitely one to keep in mind here. Money managers actually being a little more optimistic on this recent rally. One interesting sort of out there chart that I don't talk about often, and this is one that I don't find I need to report on too often, but when there's a change, it's kind of helpful. This is called the high yield option adjusted spread. And before you start, jittering because of a bunch of things that you may not be familiar with, let me break it down here. High yield bonds are junk bonds. These are the bonds of risky companies. So debt that smaller, less proven, less well-rated companies or less highly rated companies, this is the debt that they're issuing. So it's a little more risky, right? Because these are not established companies, right? Like Caterpillar issuing these bonds. These are less proven and arguably less credit-worthy companies. And that's why they have a lower credit rating. The option adjusted spread, the spread just means it's showing you the spread over treasury. So what percent over a treasury bond are you yielding by buying this debt? And option adjusted spread just means you're standardizing and looking at all these bonds on an apples to apples basis. So you're kind of exercising all the options that could be embedded in some of the more exotic structured. So you're looking at things on a level playing field. So this is basically what's the spread that high yield bonds are trading at relative to treasuries. Now, I've plotted this upside down on this chart. I've also plotted the VIX upside down, because when these numbers are going down, when spreads are narrowing, and when volatility is decreasing, stocks tend to be going higher. That tends to be good for equities. When spreads are widening, which they are over the last week, if the VIX would be going up, which it really isn't, it's remaining steady around 25 today. those kind of things would generally be related to stocks going down, because this implies that bond investors are seeing more risks out there, and as a result, want greater compensation buying this debt. This high yield spread was widening quite a bit from the February market peak to early April. Since early April, really through the last week in April, trending lower. Spreads were narrowing, but just starting to turn higher here over the last week. And I think that's something interesting, because in my experience and working with a lot of fixed income investors, while equity investors tend to be way more focused on potential returns, right? We want to hit the next home run. We want to Peter Lynch style be a rock star stock picker. So we're always looking for the next awesome thing to buy. Bond investors are way more focused on risk, because their job is to determine how likely it is that a company is going to default on their debt and not be able to meet their debt obligation and pay out their bond payments. So they're focused way more on risk. So when bond spreads start to widen, bond investors often will detect risks in the market before equity investors start to price that in. So I was always taught that fixed income markets tend to lead equities. That's why we look at rates. That's why we look at debt. That's why we look at treasury auctions. And that's why we look at high yield spreads. So for now, kind of early on to determine that's a huge rotation to widening spreads, but certainly something I'm keeping my eye on, because it looks directionally like it's starting to rotate in a period that in a direction that tends to be coinciding with weaker equity prices. So more to come as we monitor that going forward. All right, the GLD is not having a great week. Now, most of this week, it's been sort of choppy, sloppy sideways. You can see today we actually gapped lower. The GLD has what's called a doji candle. That's where the open and close are almost identical. You have highs and lows, the range around there. So a doji candle where the open and close are identical basically represents indecision, right? Something happened going into the open. Things happened during the day, but by the close, we didn't move directionally at all. We just sort of treaded water, right? So that usually suggests whatever was happening going into that candle, usually the opposite comes out. It's not perfect, right? It doesn't happen all the time, but doji candles are usually a quick red flag that says, all right, maybe a short-term reversal. So the fact that we're seeing that today after the gap lower basically means there wasn't a lot of gold selling happening during the course of the day after the gap lower. It was more just sort of chopping around there. So sort of stabilizing around 297.50 going into the close. The momentum is still good. I'm shading this green because the RSI is in the traditional range that tends to be fairly constructive. So we'll keep an eye on this as well. I think gold's certainly in a tactical pullback. The medium-term and long-term trends remain bullish as far as I'm concerned. And I do own the GLD. All right, looking at sector rotation, just want to highlight, I did my monthly chart review earlier today for my market misbehavior premium members. It's a really fun exercise that I do once a month. And it's really just sharing my normal monthly routine that I designed years ago for myself to selfishly sit in my office and go through the charts that I thought really helped me make sure I wasn't too focused on the short term and was properly respecting the long-term trends and momentum shifts. And part of that exercise is looking at sector rotation and just understanding what's working and what's not. The XLK was the top performing sector in the S&P 500 in April. Obviously, the beginning of April was pretty weak going into that low, and this is the relative performance of the technology sector spider versus the S&P 500. So going down, it's underperforming. So year to date into that April low, technology, one of the worst performing sectors. Coming out of the April low, the best S&P 500 sector. Again, still down 2.3% for the year, but going in the right direction here or through the month of April. The worst performing S&P sector was energy. And you can see that in the bottom panel, making a relative peak at the end of March and giving back all of those March gains and a little more going into the end of April. So weaker crude oil prices putting pressure on the energy side. We've got earnings tomorrow, so we'll see what we learn from the Exxons and Chevrons of the world. But for now, the charts are telling me weaker crude oil prices, weaker energy stocks. Look elsewhere for great opportunities until we see some sort of change in those trends. I mentioned it earlier in the show today, the what we call the alligator jaws, widening and closing. That's an idea I got from Nick Raich, who is an earnings strategist. He's at a firm called the Earnings Scout in Northeast Ohio. Just confirmed with him to come on the Market Misbehavior podcast. I don't know if it's next week. It might be the week after. I think it's mid-May. But he's really good with earnings, had a great career analyzing earnings for institutional investors. And he agreed to come on the podcast, sort of debrief on this quarterly earnings experience, what we learned, what his outlook is going forward as a result. He often talks about the alligator jaws, looking at valuations, looking at earnings revisions. And so that's where I got that idea from. So look forward to having Nick on the podcast very soon. But, gold has been, one of the strongest places to be in 2025, still up 23% for the year, but coming down quite a bit here in the last week or two. On the opposite side, you can see the MAGS ETF, which is basically the Magnificent Seven stocks, still down 13% for the year, but it was down as much as 25% at that April market low. So we've seen certainly a counter trend rally in big growth. We've seen a counter trend sell-off in commodities, particularly precious metals like gold and silver. The real question is the sustainability of those changes. And I would say through the course of this week and going into next week, I personally would feel a lot more confident about pounding the table and saying the market is going higher in terms of the benchmarks if names like Meta and Microsoft and Amazon and Apple can propel above their 200-day moving average. That's not necessarily what we've been observing. Let's see through the course of this week if we can get that sort of follow through. I think that would validate this uptrend pretty well. A couple of those gapped higher, certainly on earnings yesterday. We'll see what happened here on the charts in a moment. But this may be the most important chart to watch because this has been the play. This has been the playbook in 2025, right? Hard assets over paper assets, value and more, low volatility defensive plays, high quality things versus speculative growthy plays. If those trends reverse, I mean, that's a different market that some of us may or may not be very well positioned to weather. All right, let's talk about the good news. Microsoft gapped higher in a big way. We saw that in the early action in the after hours after yesterday's earnings report. Big question through the course of this week is what will happen with the big growth names reporting earnings, and then hundreds of other names obviously reporting earnings as well. Too many for us to get to on the daily market recap show. I love the gap higher. I mean, obviously the results were pretty encouraging. We talked about key resistance at 395. We cleared that. We cleared Fibonacci resistance. We cleared the 200-day. All of those things now in the rearview mirror. The only thing that's not great on this chart is the fact that we closed a lot lower than we started, right? So instead of a bunch of buyers coming in and thrilled to own Microsoft at 435, it certainly looks like the opposite. It certainly looked like some very excitable profit taking around 435 to 437, and we closed down at 425. Now, that's not the end of the day, but it certainly does not inspire confidence that there's a bunch of new buyers willing to pay more and more. This looks more like we're trending in the right direction, but facing a lot of overhead resistance, what we call a supply zone. And again, closing lower today was not great. Let's see what happens tomorrow. And if we get any sort of upside follow through, if you see people buying in to the stock around 425 and pushing it higher, that could be, a great sign of better things to come. Also watch this as we get overbought, as we reapproach those previous peaks. Microsoft, if you look to the left on the chart, it's become overbought a handful of times in the last 12 to 24 months. It's not usually been a good sign in the weeks or months to come. That's usually been a bit of a tactical pullback, if not a little bit more. Meta. So Microsoft was probably the best outcome in terms of earnings. Less great is Meta, right? So Meta, same thing, right? We had a stronger move in the after hour session. We opened around 590 today, which is pretty good open, above the 200-day moving average, above the April swing high. But look at what happened through the course of the trading day. So again, we closed up 4.25%. That's good, but we closed back below the April swing high. We closed back below the 200-day moving average. The momentum is still in the bearish range. So this is one of those, snatching defeat from the claws of victory kind of thing where, we opened higher, very encouraging, but again, we closed lower similar to Microsoft, but also we closed below the 200-day, which is kind of the level that we're watching for a lot of these names. So Meta, I think, still has much to prove to confirm that it's now in an uptrend phase here. Still TBD. All right, we've got two of the Magnificent Seven names that reported earnings after the close. Let's take a look here. So Apple at the close up about 0.4%. Pretty quiet day for Apple. I checked earlier. We were down. Yeah, we're down about 2.5% after hours. So we're currently trading around 208. So that's not bad. I mean, that's kind of taking us to yesterday's low. But this is a name that's still below its 50-day moving average, which is sloping downwards. It's clearly below the 200-day sloping downwards. I mean, this is the kind of chart that, Again, the problem is it's sold off so much. You have to regain so much just to get to the 200-day moving average. Right? We had to go from 169 up to 226 just to get to the 200-day to determine whether or not we'll hold it or not. And that's just the nature of a high volatility environment. You just have big price swings. So I would say this chart above 227, clearing the March high, clearing the 200-day, that's all bullish. I mean, I like the fact that we're trending in the right direction, but again, we have to regain some of the moving average resistance. We have to have momentum that's improved more than what we've seen so far. So for me, I'm skeptical at this point until we can get above some of this resistance. Kind of a similar look with Meta and Amazon, right? Amazon has resistance in April, early April, late April. That's kind of where we're at today. A bit of a doji-ish kind of candle, although not perfect, right below the 50-day. Amazon was up about 3% today. So let's take a look at what's happening here after the close. Down about 2%. So both of these names, not doing particularly well here. After our session, always a bit of a crapshoot. We'll see what happens tomorrow, but it's currently trading down around here below today's price range. So if we get through today and Apple and Amazon, instead of gapping higher and seeing additional buying power, instead sort of trade lower and have additional selling, that is not a great outcome, particularly because the benchmarks are geared toward these types of names. And Apple, one of the biggest weights in the XLK, which was the top sector in April. Amazon, biggest name in the XLY, obviously a key name to watch. We'll see what happens. Tomorrow, as a reminder, we've got the PCE data before the open. That could be certainly an important one. Jobs, all of that. All right, let's look at a couple other charts. This might be the last one. Here we go. Last chart for the day is looking at payment processors. We got Visa and MasterCard. Visa was one of the names that I shared on that top 10 chart special that I mentioned on Stock Charts TV. So check that one out with the other 9 ideas that we talked about. We went through Visa in a lot more detail, but I think the argument for a chart like Visa is we found support at an ascending 200-day moving average. We've had a number of times over the last couple of years where Visa has traded down to the 200-day, maybe gone slightly lower, but regained the 200-day in all of those situations. And sort of more to come here in April, more of the same. Now we've broken above trendline resistance. So Visa in the top panel breaking above that swing high around 340. MasterCard in the bottom panel. MasterCard's reporting earnings today. Breaking above the trend line, that's good. Breaking above the late March peak around 560, I think would complete that pattern. So both of these getting above these late March swing highs, I think are really good charts with upside potential. We can debate and discuss, whether the macro conditions are good for Visa or MasterCard. I mean, the argument for here, besides earnings and what we hear, is the fact that people probably are using credit more than other times. If prices are higher, they're most likely going to be leaning on credit. Things are more expensive. They probably don't have the cash available, maybe necessarily. We'll see. But for now, the chart's indicating a bit of optimism here as we break above trendline resistance. All right, we'll take a question or two. And as I'm bringing up the questions, I mentioned interviewing. Who did I just interview? Oh, John Roque. I interviewed him earlier today. I don't think I mentioned that. I interviewed John Roque on the podcast. That's not ready. That'll probably be out for you tomorrow morning. John Roque has had a really fantastic career as a technical analyst on the sell side at brokerage firms in New York, in the hedge fund community, working for Tudor Investments and other shops, and now in the independent research space, institutional research. So he works for a research firm, 22V Research, and they do a really good job. A bunch of ex-ISI analysts, which is a widely followed independent research firm. He's a fantastic technical analyst. I used to meet with him often when he would come through Fidelity when I was there. It was a really cool conversation about a lot of different themes, applying technical analysis, relative strength, technical analysis versus other disciplines, a lot of discussion about leadership and momentum and making sense of 2025 from a technical perspective. So when that's out, I'd encourage you to watch that. It was a really cool discussion and a super nice guy. All right, let's take a question or two here. Sorry, I'm trying not to pay too much attention to entertaining comments here. UNH is a good one. Let's take a look. Healthcare having a tough day here today, where I just saw it and then flew right past it. KC, thanks for watching on YouTube. Appreciate your opinion on UNH. Let's go there. All right, so let's bring up United Healthcare. As I mentioned, United or Healthcare, not the not the worst sector in April, but the next to worst sector in April. Um, Here's the thing with UNH, right? I was taught one of the first things I was taught as a young analyst was don't confuse the bottom of the page with support, and I was taught this during like the 2001 2002 period, and this was after technology names had just had these ridiculous rises in the late 90s. I started at Bloomberg in June of 2000. My introduction to market analysis and technical analysis was a period where things that had just been so unstoppably bullish all just looked very vulnerable and started to rotate lower. Then when they started to test support, right, and they start to hit the lows, you're looking at like a 6 month chart. All of a sudden, you'd hit the bottom of the screen, and I remember seeing it and just thinking, all right, well, that obviously that's at the lows, or we should be buying. And the mentor that I was working with said, dude, don't confuse the bottom of the page with support. Like, just because something's gone down to the lower end of the viewable area does not mean it can't go a lot worse, right? I then learned that prices go down for a reason. When something like UNH gaps downwards and then continues to sell off, that's not bullish. And so it's oversold. At some point that ends up being probably, representing some sort of buyable opportunity, but not today. And I think from a medium term to long term perspective, the challenge is when we gap lower like this, again, just thinking of the investor psychology behind this chart, if there's things to like here, I would expect a chart like this to start finding support where it's found support before. And people that were thrilled to buy it around 440 back here probably be thrilled to still buy it here. But you have an absence of buyers, right? Anyone that owns the stock's probably already in it, and there are a lot more people underwhelmed about the chart at the particular moment. So the gap lower, not really bought. You don't see a lot of demand coming in. You see additional distribution. So I think the fact that we've broken below the lows is just not bullish, right? Just like the new highs list is pretty encouraging. The new lows list I've learned to avoid until you see signs of accumulation. So on a chart like this, what I often do is immediately zoom out because it looks like we're at the lower end of this range. So I like to bring in a lot more data and just start to get a sense of what it's telling me. Here on the weekly chart of UNH, you can see those lows kind of back here in that 430 to 450 range. You can see how many times that held in 22, 23, 24. That level's now been broken. So what I often do on the weekly chart is go to the very bottom. You have the PPO indicator with after the rally up to 600 has now broken down. We can see the weekly PPO in a bearish phase where the PPO line's below the signal line. You wait patiently for a buy signal, and it might not be a perfect entry point, but by waiting for that, you get a sense that there is finally some sort of accumulation happening on the stock. So for now, I would say UNH is going down. It's breaking to new 52-week lows. That is not a type of chart that I would personally be interested in. If you're a contrarian, I would tell you, remember, don't confuse the bottom of the page with support. Look for signs of accumulation. Look for signs that there are people actually looking for an opportunity here and expressing that optimism by taking on a position. Let's see. Microsoft on the weekly chart. HC, thanks for watching on YouTube. Monthly gap up. What does that mean to you? Here's the thing. Some people are really big on monthly candles. I am not one of those guys, and I will explain why. Daily candle charts, right? What's beautiful about candle charts is that they tell you a story about a particular period of time. So a daily candle and looking at patterns like doji candles or hammer candles or something like that, I think has meaning because there's a defined open, there's a defined close, and then there's this candle, which basically summarizes the price action during that day or during those 2 or 3 days and whatever you're looking at. So I think that has meaning. A weekly candle, I think, makes a ton of sense because you have a Monday open and a Friday close and a bunch of stuff in the middle. And so that is a clearly defined period that I think makes sense. A monthly candle, and again, looking at the trend on the monthly chart, totally get it. But looking at monthly candles and assuming some sort of value to a pattern, yeah, I don't think that has particular relevance because the 30th of one day, like today, April 30th was yesterday, it was a Wednesday. May 1st is a Thursday. There wasn't a big separation between yesterday's close and today's open, different than other times during the month, right? It was just sort of a Wednesday to a Thursday. So, assuming that the candle itself has meaning, I'm less a fan of. And I would have the same argument with like a 65-minute or an hourly candle. I don't think using candle patterns on that time frame to me makes a ton of sense. Does it make sense to look at charts on those time frames? 100% it does. So what does that gap mean? I mean, I think the monthly chart at this point, if you're trying to understand that price gap, I would much rather look at the daily chart and the weekly chart and see how that relates to the overall trend. On the monthly chart, the purpose of the monthly chart for me is to really understand the big phases, right? And the big long trends, and make sure that I'm generally on the right side of uptrends and not on the wrong side of downtrends. And looking at things like monthly PPO just as a gut check to say, overall, what is this longer term price structure, right? The benefits of the monthly chart are not to zoom into the last, day. It's to look at the last 20 years and really think about where we're at relative to where we've come. So I guess that's a long-winded way of saying I don't assign a ton of value to this particular gap. What this does tell me is look at the daily chart and look at the weekly chart. And if I'm trying to understand that period, I got to zoom in to get that sense. I zoom out to this monthly chart to provide some more longer-term context, big picture ideas about how that gap might fit into the overall trend phase. Folks, that'll do it for today. Some good questions I didn't get to, including a suggestion for Louise Yamada. That's a really good one. I know Louise well, and we'll see if I can convince her. With some technical analysts that have sort of moved on from actively analyzing the markets day to day, I'm having trouble convincing some of them to get on camera and share some words of wisdom. I'll see what I can do with Louise. I'll get to work on that. But thanks for that suggestion. Any other suggestions you have on people to interview for the Market Misbehavior podcast, let me know. I'm always open to some new ideas. That'll do it for today. Thanks so much for joining me here on the show. As a reminder, all of our replays of our episodes, including our Friday mailbag episodes, are on our YouTube channel. For Market Misbehavior, I'm Dave Keller. Have a great evening. And remember, it's always a good time to own good charts. Take care, folks.